Have you ever looked at your whole life insurance policy and just had a feeling that there's more to it than meets the eye? Like there are some powerful features kind of hidden in the fine print? Well, you're not wrong. Today, we're going to pull back the curtain on the secret financial engine built right into your policy, its cash value, and more importantly, the rights that you have to it. So let's just jump right into the big question, the one that probably keeps some policyholders up at night. You've been paying into your life insurance for years, maybe even decades, but then life happens. You hit a financial rough patch and you just can't make that next payment. Does all that money you've paid in just poof, vanish? Do you lose the policy and every single dollar of equity you've built up? Well, let me put your mind at ease. The short answer to that scary question is nope, not anymore. That fear of losing everything, it's totally understandable, and it's rooted in a past reality. But trust me, the rules of the game have completely changed, and they've changed in your favor. And see, this is why that fear exists. There really was a time back in the day when if you missed a premium payment and that grace period ran out, your policy would lapse. And the insurance company, they could legally just keep every penny of the equity you'd built. It was a really harsh system. But this right here, this is the absolute game changer. To fix that exact problem, states across the country adopted what's called the Standard Non-Forfeiture Law. What this law does is actually really simple, but it's incredibly powerful. It says that if you stop paying your premiums, the insurance company has to give you access to the cash value you've accumulated. You cannot be forced to forfeit your own equity. This law is the foundation for everything we're about to talk about. So all this talk about equity and cash value, what are we actually talking about here? Let's break down this core concept, because it's the key to the whole thing. Honestly, the easiest way to think about cash value is to just compare it to the equity in your home, right? As you pay your mortgage month after month, you build ownership in your house. It's this same exact principle with whole life insurance. As you pay your premiums, a portion of that payment builds your equity inside the policy. It is your asset, it's your money, and it's protected by law. So how does this pile of equity actually grow? Well, it all starts with a guaranteed rate. That's the baseline growth that's written right into your contract, no matter what. But, and this is a big but, it can often grow even faster. This happens through something called an excess interest provision. Basically, it means your cash value can earn extra interest that's tied to either an economic index or how well the insurer's own investments are doing. This can really help accelerate your policy's growth. Okay, so let's circle back to that scenario where you've decided you just can't pay the premiums anymore and you need to walk away. Because of that non-forfeiture law we talked about, you don't lose your equity. Instead, the law gives you 3 very distinct choices. And here they are, a quick look at your 3 exit strategies. You can take the cash and run, which is called a cash surrender. You can convert your policy into a smaller but permanent policy that's completely paid up for life. Or you can use your equity to keep your original death benefit, but just for a fixed amount of time. Each one has a very clear trade-off, as you can see. Option 1 is the most straightforward, cash surrender. You basically say, I'm done. You terminate the policy, and the insurance company cuts you a check for your cash value, minus any loans you might have. Now, for taxes, the money you get back up to the total amount you paid in premiums, that's your cost basis, that part is tax-free. Any growth on top of that gets taxed as ordinary income. Option 2, reduced paid-up insurance, is a fantastic choice for people who still want lifelong coverage, but just need to stop making those payments. You take all your cash value and use it as one single lump sum premium to buy a smaller, permanent life insurance policy. And get this, no more premiums are ever due, ever. And this new, smaller policy even keeps growing its own cash value. Pretty cool, right? And finally, there's the extended term option. This one is for when your number one priority is maximizing the death benefit for your family. You exchange your cash value for a term insurance policy with the exact same face amount as your original policy. So you get the most protection possible, but it's only for a set number of years. And here's a really important thing to know. If your policy lapses and you don't tell the company what you want to do, this is often the default option they'll pick for you. But hey, what if you just need cash for a little while? What if you don't want to give up your policy at all? Well, that brings us to another incredibly powerful feature, the policy loan provision. A policy loan is just fundamentally different from a regular bank loan. Think about it. With a policy loan, there's no credit check, there's no long application process, and there is no mandatory repayment schedule. You're basically just getting an advance on your own policy's future payout. So if you don't pay it back, the consequence isn't a hit to your credit score. It's just a reduction in the final death benefit that your heirs receive.
So how's it work? You're borrowing against your cash value, which acts as the collateral. You can usually borrow up to the full cash value amount. And while you don't have to pay it back on any set schedule, any unpaid loan balance, plus whatever interest has accrued, will be deducted from the payout when the insured passes away. It's that simple.
Now, this brings us to the one major risk you really need to keep an eye on. You do have to pay interest on the loan. If you just let that interest pile up, and the total loan balance eventually grows to be bigger than your policy's cash value, the policy itself can lapse and be terminated. So while it's an amazingly flexible tool, you do need to manage it.
Now, for our final feature, and this one is a true set-it-and-forget-it safety net. It's designed to protect you from an accidental mistake, and it's called the Automatic Premium Loan.
The whole purpose of this feature is just beautifully simple. It's there to stop your policy from lapsing just because you forgot to pay the premium. Maybe you were on vacation, maybe the bill got lost in the mail. It's a protection against simple human error. Here's exactly how it works. So you miss a payment. The 30-day grace period ends. Now, instead of your policy lapsing, boom, the insurer automatically takes a loan against your cash value for the exact amount of the premium you owe. Just like that, your policy stays active, your coverage continues without a single interruption, and you've avoided a potentially huge mistake. But there are a few really key details you gotta know. First, and this is the big one, this feature isn't usually included by default. You have to actively choose to add it or elect it, usually when you first buy the policy. The good news? There's almost never a charge to add it. And of course, it only works on policies that have cash value, and it can only keep paying those premiums as long as there's enough cash value to cover the loan.
Okay, let's bring this all home. Here are the key takeaways. Number 1, your policy's cash value is your equity, and it is protected by law. You can't be forced to forfeit it. Number 2, if you have to stop paying, you've got 3 clear options for what to do with that equity. Number 3, you can access that cash value through a policy loan, which is way more flexible than a bank loan. And finally, number 4, you can add an autopilot feature to protect yourself from accidentally letting the policy lapse. So you see, when you really understand these provisions, you realize that your policy is so much more than just a death benefit that's going to be paid out someday. It's a living, breathing, flexible financial asset that you can actually use during your lifetime. So I guess the real question is, now that you know what's possible, do you know how to use yours?